International Public Sector Accounting Standard, or Ipsas 26, is a crucial guideline for public sector entities. It deals with the impairment of cash-generating assets. You might ask, what does impairment mean in this context? Simply put, an asset is impaired when its carrying amount in the financial statements is greater than its recoverable service amount. This standard ensures that assets are not overstated on the balance sheet. It provides a clear framework for identifying these losses, measuring these losses, reporting these losses. This helps create more accurate and reliable financial reports. The main purpose is to reflect the true economic value of an entity's assets, which is a cornerstone of transparent financial management and public accountability. This standard is part of a larger set of Ipsas standards. These standards aim to improve the quality of financial reporting by public sector entities around the world. By adopting Ipsas 26, governments and public bodies can present a truer and fairer view of their financial position. This is not just a technical accounting exercise. It is a commitment to transparency and responsible stewardship of public resources. When the public and other stakeholders can trust the financial information presented, it enhances confidence in the government's ability to manage its affairs effectively. This standard provides a disciplined approach to asset valuation, moving away from historical costs that may no longer be relevant. Ipsas 26 specifically focuses on cash-generating assets. The importance of Ipsas 26 for Pakistan public sector cannot be overstated. It is a powerful tool for enhancing transparency and accountability. In Pakistan, many public sector entities hold significant cash-generating assets. Pakistan International Airlines, Pakistan State Oil. For years, asset valuation may have been based on historical costs, without considering declines due to damage obsolescence changing market conditions. Adopting Ipsas 26 compels entities to present a more realistic picture of their financial health. This honesty is the first step toward making informed decisions about restructuring investment divestment. These choices are critical for Pakistan economic stability. Accurate financial reporting builds trust between the government and its citizens. International Monetary Fund, World Bank. Globally recognized standards make statements more credible and comparable. This helps Pakistan strengthen its economy and attract foreign investment. Investors. Lenders need assurance that they are looking at reliable financial data. Implementing Ipsas 26 signals commitment to good governance and fiscal discipline. It shows Pakistan is managing its public resources responsibly and transparently. Ipsas 26 provides valuable information for decision-makers. The first step in applying Ipsas 26 is to identify whether there are any signs that an asset might be impaired. This is not something you do randomly. The standard requires public entities to assess assets at the end of each reporting period. You are essentially playing detective, looking for clues that an asset value may have dropped. External indicators, internal indicators. It is a proactive process that ensures potential problems are identified early. You do not have to calculate the impairment for every single asset every year. You only proceed to the next step if you find a concrete indication of impairment. External indicators are clues from the world outside the organization. For example, a significant decline in the market value of a similar asset. Major negative changes in the technological environment. Major negative changes in the market environment. Major negative changes in the economic environment. Major negative changes in the legal environment. The most obvious one is physical damage to the asset. Fire, flood, accident. Another internal indicator is obsolescence. For instance, a report might show that an asset is performing much worse than expected, or that the costs to operate and maintain it are much higher than budgeted. Once an indicator of impairment has been identified, the entity must proceed to the next step, formally estimating the asset recoverable service amount. After identifying a potential impairment, the second step, measure the asset recoverable service amount. This is technical. Concept is straightforward. Recoverable service amount equal. Sign higher of two values. Fair value, less costs to sell value in use. Calculate both, pick the higher. That higher value is what you could get by selling or by continuing to use it. Compare that to the carrying amount to check for impairment. fair value less costs to sell, equals sale price in an open market, minus cost directly linked to the sale legal fees, stamp duty, costs of removing the asset. If no active market, common for specialized public sector gear, value in use, equals value from continuing to use the asset. Estimate future cash flows the asset will generate over its remaining useful life. Discount those future cash flows to present value. A rupee in the future is worth less than a rupee today. Calculating value in use needs judgments about future revenues, operating costs, and the appropriate discount rate. Choose the higher as the recoverable service amount. So, the third and final step in the process is to recognize and measure the impairment loss itself. This step is only taken if the recoverable service amount, which you calculated in step 2, is less than the asset carrying amount on the balance sheet. The carrying amount is typically the asset original cost minus all the accumulated depreciation and any previous impairment losses. If the carrying amount is higher, it means the asset is overvalued on the books. The difference between the carrying amount and the recoverable service amount is the impairment loss. This is the amount by which you need to write down the value of the asset. Once the impairment loss is calculated, it must be recognized immediately in the financial statements. This means the loss should be recorded as an expense in the statement of financial performance, which is kind of like the public sector version of an income statement. At the same time, the carrying amount of the asset on the statement of financial position or the balance sheet must be reduced by the amount of the loss. This action ensures that the asset is now stated at its recoverable service amount, which is a more accurate reflection of its true economic value. And just to be clear, this is not just an accounting entry, it's a formal acknowledgement that the asset has lost some of its service potential. After recognizing an impairment loss, the entity must also adjust the future depreciation charges for the asset. Since the carrying amount of the asset has been reduced, the basis for calculating depreciation has changed. The new, lower carrying amount should be depreciated over the asset remaining useful life. This ensures that the cost of the asset is allocated systematically over the period it is expected to provide service. The entire process aims to align accounting records with economic reality. Let's consider a practical example from Pakistan public sector. Imagine a large government hospital in Lahore. It purchased a specialized MRI machine 10 years ago for 200 million Pakistani rupees. The machine has a useful life of 15 years. Using straight-line depreciation, accumulated depreciation after 10 years is about 133.3 million rupees. So the current carrying amount is 66.7 million rupees, which is original cost minus accumulated depreciation. That book value may not reflect its true current worth. Management learns a new advanced MRI tech is widely available. It gives clearer images in half the time. Private hospitals are upgrading. Patients prefer the new machines. This technological change is an internal and external impairment indicator. Step 1. Option 1. Market. Could sell for 20 million rupees. Minus 1 million dismantling and transport equals fair value less costs to sell. 19 million rupees. Option 2. Value in use, remaining 5 years, net cash inflows. Present value, 25 million rupees. Recoverable service amount, equals the higher value, 25 million rupees. Impairment loss, equals 41.7 million rupees. Record the 41.7 million as an expense for the year. Reduce the carrying amount on the balance sheet to 25 million rupees. Pakistani public sector institutions face several significant challenges when trying to implement Ipsas 26. One of the primary hurdles is the lack of technical capacity and expertise. Calculating value in use fair value less costs to sell requires specialized skills in financial modeling valuation forecasting. Many public sector entities do not have staff with the required training or experience to perform these complex calculations accurately. Another major challenge is the availability of reliable data. To estimate future cash flows for the value in use calculation, managers need historical data on revenues, operating costs, maintenance expenses. In many Pakistani public entities, record-keeping has traditionally been weak, and this data may be incomplete, inaccurate, or not available at all. There is also a cultural resistance to change within the public sector bureaucracy. The shift from a simple cash-based finally, the cost of implementation itself can be a barrier. It may require hiring external valuation experts. To overcome the challenge of limited technical capacity, a phased and strategic approach to training is absolutely essential. The government of Pakistan should develop a comprehensive national training program, Auditor General Office Controller General of Accounts. This program could include Train the Trainer initiatives, a core group of experts trained intensely, then tasked with training others across ministries and departments. Partnering with professional accounting bodies can provide access to trainers. Standardized certification programs focused on Ipsas. To address data availability, public entities should improve asset management and record keeping. Create and maintain comprehensive asset registers. Track the cost of an asset. Track maintenance history. Track performance data. Track physical condition. Where market values are not available, develop internal models or use professional valuers. Overcoming cultural resistance requires strong, consistent leadership. Senior officials in the Ministry of Finance communicate that the standard is a tool for better management, not a weapon for punishment. Publicize success stories from early adopters. Manage costs with a phased rollout plan. In conclusion, successful adoption of Ipsas 26 is not just an accounting upgrade. It's a fundamental step towards enhancing fiscal discipline, transparency, accountability in Pakistan public sector. This standard provides a robust framework ensuring the value of public assets is reported accurately, preventing overstatements and providing a true and fair view of an entity's financial position. The journey to full implementation is, of course, fraught with challenges, technical skill gaps, data deficiencies, and cultural resistance. However, these obstacles are not insurmountable. With a strategic, phased, and well-supported approach, Pakistan can successfully navigate this transition. My key recommendation is for the government to establish a high-level steering committee to oversee the national Ipsas implementation strategy. This committee should include representatives from the Ministry of Finance, the Auditor General of Pakistan, the Controller General of Accounts, and professional accounting bodies. Its mandate should be to set clear timelines, develop standardized guidance, coordinate training efforts, and monitor progress. Strong, centralized leadership is the single most important factor for ensuring a consistent and effective rollout across the entire public sector. It should involve embedding Ipsas principles into the curriculum of public administration and accounting education in Pakistan.